Hi, and welcome to my monthly Market Insights video. My name is Dan Timitich. I'm a Managing Principal and Portfolio Manager at T2 Asset Management. Before we get started, remember this video is for educational purposes only. The opinions expressed in this video are mine and don't reflect the opinions of other managers. You should always consult with your financial advisor before making any investment decisions. Investments involve risk and are not guaranteed. Okay, well, January sure was interesting. Before we get into the outlook, some of you may have remembered this chart from last month's video, but I wanted to quickly touch on it once again to remind you of the three different phases we went through in 2019. First, we had the rebound phase, which lasted between January and April of last year. The initial rally to start the year was simply a rebound from the oversold position of the fourth quarter in 2018. And after the market recovered, focus shifted to earnings and the Fed, which led us to the next phase, the consolidation phase between May and September. The market fell about 7% in May, but it quickly rebounded in June as the Fed did a complete 180. The Fed was now on the side of the markets and started cutting rates, and yet the market didn't do really anything from May through September. It was clear that earnings were not growing, and there were some other issues that were pressuring the market, which brings us to the third phase, the Fed's new QE program. The Fed reignited their quantitative easing policy. Regardless of what they may say, they are now in QE mode, and the market was correct in its concerns over earnings, and the lack of performance from May to September was justified. And when the Fed stepped in again through the repo market, that's when the QE really started. Now, most of you probably never even heard of the repo market, but it's the short-term funding market that keeps financial markets lubricated. Think of it kind of like oil in your car. If you don't have any oil, your pistons are going to freeze up and your engine locks up. By the end of September, there were real problems showing up in the repo market. Cash to fund the market dried up, so the Fed began another quantitative easing policy and started injecting $60 billion into the market and continues injecting about that much every month since then and to this date. To date, they've pumped in somewhere around $400 to $500 billion into the system. With this fuel, the market clearly went on a tear to finish the year, and I'm going to talk about that a little bit more in just a moment. So with the market supported by the Fed, did January continue to run higher? Well, it started to. The market rose about 3% in the first half of January, and then we got hit with the coronavirus. The market spent the second half of January falling about 3.5% and ended the month down just fractionally, basically flat for the month. Last month, we did identify, and I talked about 5 issues that concerned me going into 2020. Those factors include the Fed, earnings, interest rates, valuations, and stock buybacks. Today, I'm going to be focusing in on 3 particular ones: the Fed, earnings, and valuations. I mentioned at the beginning of this video that the Fed had reignited its quantitative easing policy, and this chart here clearly shows that. This is from the St. Louis Fed and shows that the Fed had been reducing the size of its balance sheet from about $4.5 trillion, $4.4 trillion in early 2018, all the way down to about $3.75 trillion by the end of September 2019. That's about $700 billion that they took off the table. Well, in October, when the repo market started to have some real problems, the Fed stepped in to save the day and began pumping billions of dollars into the repo market. The Fed's balance sheet quickly ballooned to nearly $4.2 trillion, and they continue to flood the market with billions of dollars each day here. Now, the Fed has said that this is not QE and that this is only temporary. Well, if it sounds like a duck and walks like a duck, you get it. Anyway, we won't really know how temporary this QE program will be. What we do know is that the Fed has done this before. So let's take a look at what happened. This chart here is from Bianco Research, and back in October 1999, the Fed pumped billions of dollars into the market over Y2K concerns. And while the NASDAQ was already up about 40% by the time they started their funding, the Fed fueled an additional 46% gain in the fourth quarter of 99. When nothing happened after the clock turned to January 1, 2000, the Fed realized it needed to take back some of that liquidity. It did so on April 7th, and the NASDAQ crashed 25% in a week and finished the year down 40%. I remember those days clearly. It was so obvious that the Fed was responsible for creating the NASDAQ bubble, and when they took away the punch bowl, the market responded. So is it different this time? Only time will tell. Here we have another chart from Bianco Research showing the S&P 500 in 2019. The market was up already about 20% by the time the Fed stepped in and pumped billions of dollars into the repo market. That fueled another 9% performance to the market. The Fed has indicated that they plan to stop adding liquidity around April 15th. If they do, what's going to happen to the market? Nobody can say for sure, but if history is any indication, I would expect the market to pull back between 10 and 15%. Why? The Fed is responsible for about half of the returns of the NASDAQ back in 1999, and they're responsible for about half of the return of the S&P over the last year. If they were to stop pumping money into the system, you should expect the market to give back some of those gains that came from that policy. Now, I don't want to sound too negative here since I still believe that we're going to have a good year in 2020, but the market is expensive and it needs to come down to more reasonable levels, which brings us to the other two factors, earnings and valuations. Earnings in 2019 were terrible. It looks like the S&P 500 earnings growth was basically flat for the year, as this chart from FactSet shows. There were some bright spots in healthcare, utilities, and communication services, but there were also some really ugly numbers coming from industrials, materials, and energy. With earnings so weak in 2019, analysts are now expecting earnings to grow about 9% in 2020. Before we get too excited, we do need to reflect on how good these estimates have been over time. Analysts are notorious for being overly optimistic at the beginning of calendar years and then being forced to lower expectations throughout the year. Here we have a chart from Crestmont Research that shows how forecasting earnings has been difficult. And like Yogi Berra once said, it's tough to make predictions, especially about the future. As an example, just looking at this chart, about 1 year ago, analysts were forecasting 2020 earnings to come in around 173. Today, they expect earnings to come in around 162. Want to guess what it's going to look like in 6 months? Look, it's hard to forecast earnings for many reasons, and that's why I think that the market is too expensive given the uncertainty around earnings and the Fed. Now, many pundits are on TV trying to justify these market multiples based on expectations for earnings growth this year. But here we have another chart from FactSet that shows that the current PE ratio is about 18.7 and is at the highest level since 2002. The valuation today is above its 5-year, 10-year, and 20-year averages and currently implies earnings of about 177 for the S&P. If earnings don't grow by 10% this year, you're going to see the market pull back to more reasonable levels. What happens if earnings only grow 5% and come in somewhere around 146? Well, at this level, it would imply that the PE is 23, which would put us back to levels that we haven't seen since 2000. So if earnings do not live up to their lofty expectations, I would expect to see some sort of a pullback and bring in these valuations down to more reasonable levels. As I've said before, I don't want to sound too negative on 2020, but there are reasons to be cautious and patient as the year unfolds. The Fed is the biggest question mark on the markets. Are they going to continue QE forever or force the market to take some of its own medicine? Analysts and other pundits have some real lofty expectations on earnings that may or may not come to fruition. And with the market so expensive today, it's just prudent to take some of these gains here and wait for the market to pull back to more reasonable levels, or wait for earnings to prove that these market levels are justified. You don't have to run for the door, and I'm not recommending that you sell everything out, but locking in some gains is not a bad thing to do right here, even if it means you miss out on some of the additional upside. Remember, nobody has ever become rich by picking up pennies in front of a bulldozer. And finally, we have the coronavirus. The true impact of the virus is yet to be determined, but when an economy the size of China shuts down, even for a brief period of time, there is going to be a significant impact on the supply chain and therefore overall global GDP. Some are trying to compare this virus to SARS, but back then, China was just a fraction of the size they are now, and the world is much more dependent on them. So we're just going to have to stay tuned and see how this coronavirus epidemic unfolds. Thanks again for watching. If you want more information, please give me a call or send me an email. I'll be back next month, and until then, have a great day.